Good morning, everyone, or good afternoon, shall I say, in case we have people in the Central European time and it's 30 seconds past noon. My name is Louis Carbonnier. I'm a co-founder and president at Hokodo. Very happy to host this webinar today. I suggest that we just give 1 or 2 minutes for people to join and register. In this world of Zoom and back-to-back phone calls, there's often the need for this 1 or 2 minutes of extra buffer time. And before kicking off, you can probably see on the right-hand side of the screen the star-studded roster of panelists that will introduce themselves in just a couple of minutes when we start. Maybe just 1 more minute. Let's make ourselves comfortable and be ready to talk about all things finance, e-commerce, and how e-commerce actually impacts the finance function. Okay, so it's 11 a.m. in the UK. It's 12 here in Paris. Let's kick off. My name is Louis Carbonnier. I'm co-founder and president at Hokodo. We set up Hokodo in 2018 to empower merchants selling online to grow faster with confidence by offering instant payment terms to their customers. And you can see already that the worlds of finance, commerce are very, very connected, and hence why I'm super excited about the webinar. And the reason why we're hosting this webinar today is that we're releasing a brand new report that you can see on screen in conjunction with the Business Partnering Institute represented by Christian that you see on the screen. He'll introduce himself in just a second. And these reports talk about finance readiness for digital transformation of B2B e-commerce. And what's happening to B2B commerce, it's migrating online, migrating fast, and this brings a whole lot of changes that we're about to discuss. So we're together for 45 minutes. Let's start with a quick intro, give you an overview of our panelists and the insights that they can bring to the table. Then I'll take a few highlights from the report, share them with you in a very condensed format, but I encourage everyone to download the report and get access to a lot more insights on the transformation of the finance function. And then we'll have 40 minutes of panel discussion where the 4 gentlemen accompanying us today will share their views on how the finance function is transforming. So first things first, let's start with a round of intros. I'll go from left to right. John, I think you're in Scotland today.
Yep, that's it. I'm based in Glasgow. My background is I qualified, like many of us, in audit, and I've since held a number of senior finance positions across tech, oil and gas, financial services. I'm currently the CFO of Tavio Group, which is an insurance scale-up based in the UK. And in addition to that, I've got a number of fractional positions at CFO level as well. My specialities include modelling, forecasting, process improvement, and everyone's favourite topic, cash flow management. And I'm delighted to be here and look forward to it. Thank you.
Thanks, John. Well, I guess with this variety of experiences cutting across different companies, you'll have a special light to shed today on the report. I think that it's also the case with you, Christian, and joining out of Copenhagen today.
Yeah, definitely Copenhagen based. So I'm balancing John's CFO expertise as an external advisor. I'm a partner at Business Partnering Institute. So we're a niche consulting firm focusing on elevating the potential of finance professionals, specifically through finance business partnering. So I get to work with a lot of great companies and finance professionals globally on upskilling them and, actually, building a lot of things on top of the hardcore finance acumen that we all have as a foundation. So that's me.
Good to have you, Christian. Thanks a lot. Then next up, Oman.
Thanks, Louis. So I'm Amin. Like Christian and John, I've been in financial services and finance for about a decade now.
Long.
Yeah. Actually, like I've spent my last 7 years actually building out finance teams in fast-growing tech businesses, mostly in financial services. So happy to be here. And we mentioned, but I've been working at Hakoda for a while and really excited about what we're building here.
Thanks a lot, Oman. And last but not least, Jorge, based out of Spain. Well, I should say Catalonia.
Thank you, Louis. Yeah, well, I've been working on the solar energy industry for the past 8 years, particularly in the portion of finance, project finance, raising debt or equity, and well, trying to also through business analytics have some strategic decision making. Right now in Solvent, what we try to do is to offer a solar solution, but we call it a solar as a service, meaning we try to optimize this for both B2B and B2C projects so that people can access solar energy in a simple and efficient way.
Nice. Thanks a lot, Jorge. So with this, you can see the diversity of experiences that we have across the finance function, which shows the panel so that you have that, end-to-end coverage of finance, including some of us with a more financial services angle. I think what's also interesting, but it's a bit a produce of coincidence, is that we're all based in different countries today. So we'll see if that kind of local variation comes through when we discuss, or if those trends are actually impacting all of Europe and beyond at the same time. So before we dive into the research and the results, maybe a quick glance into why we did this. At Hakoda, we're 100 people dedicated to B2B payments and trade credits, especially in the context of B2B e-commerce. So being the European leader in digital trade credit solution, we're really in a good spot to assess how those trends of increasing migration towards online sales is impacting the CFO function in general. And what we see a lot is that there's this kind of typically our primary port of call at the client is often going to be a conjunction of commercial director and finance director. And it's really fascinating to see that the commercial director wants to deliver the best user experience, the best payment methods to their customers. But this is actually something that can only be delivered with very strong partnering from the finance function. And in a way, there's a kind of new discipline that's emerging, which is a combination of commercial, payments, finance, that assesses those trade-offs at the highest level for each of our clients. So this is some of those challenges that have been uncovered by the report that we commissioned. And we hope that this webinar today will come up with some nuggets of information and actionable advice for everyone as you run your business day to day and as you navigate that transition from offline B2B commerce to online. And we also partnered with the B2B e-commerce association because a lot of what we're discussing today concerns those online sales and how we can develop an omni-channel experience to a B2B customer who's actually expecting not just in-store or telesales, but also the online channel. Maybe let me talk you now through a couple of the insights. I'll just take 5 minutes, but there were a couple of striking numbers coming out of this research. So the first one is this tension that we found more than before about the challenge to balance financial controls and growth. And we really sit at a lot of our clients that there's this drive for more innovative payment methods, user experience, new channels, and at the same time, the need to keep control on the costs, on the risk, on the capital position. And it's almost like a triangle where you want to give the best customer experience, the best payment terms, at the same time manage the cost of your payment methods and preserve your capital position, not take too much risk of uncollected debt, that kind of stuff. And this is really where we feel the finance function currently being, feeling that tension and the dilemma. I'm looking forward to hearing from our practitioners how they manage this tension between controls, having the shop in order, and growth. Then 66% of our finance leaders don't think their teams can keep up with the speed of e-commerce. And this is actually quite a concern, because when we talk to our merchants, including enterprise merchants in Europe, what they tell us is that the fastest growing channel they have is currently e-commerce. Telesales have reached their potential, sales reps are maxed out, they're not very cost efficient. In-store sales are pretty much stalling, if not struggling. I think we're really at that tipping point where during COVID, for the first time in history, online sales in B2B overtook in-person sales. So really this migration to online is challenging the business models of our clients in depth. So I'm looking forward to seeing how they manage this and how they see their own colleagues dealing with these challenges. Something also that appeared is like, you may have seen this, there was a McKinsey study earlier this year that showed that 73% of the B2B buyers were millennials. And if they're millennials, it means that there are people who have always experienced a mobile phone, who are used to buying on Amazon, on eBay, and have that kind of one-click checkout experience. And if they do this in their personal lives, they actually also expect it when they're at work. And that McKinsey study showed that these, 73% of them were millennials, and they're actually comfortable making purchases online worth more than 50,000 euros. So, a 50K order in B2B is not uncommon. And as a company, every week we see orders north of 50,000 euros. So this is something also that changes the paradigm of how we manage e-commerce and how, as finance controllers, we need to deal with things like KYC. Is there a risk of non-payment? What is it going to do to my balance sheet? And with that kind of speed of e-commerce, all those decisions that used to be made over 48 hours are now coming under massive pressure. Now, top 3 challenges we had for this year. I think this one always fluctuates a little bit depending on the environment, but lack of cash flow predictability affecting 2/3 of respondents, a constraint of going back to improving profitability, so cost cutting, affecting about half of respondents, and then managing payments and payment terms, which I link also to cash flow predictability, because we've entered post-COVID with all the government support being withdrawn. We've entered a world of higher insolvency, more late payments. I think that cash flow unpredictability also comes from customers paying late or not paying at all. So that's 44%. Then 54% of finance leaders have had to impinge on the payment terms of a key customer due to risk factors. So in general, when we look at our customers, we see that they give adequate payment terms to about 20 to 30% of their portfolio. This means that 70% of their customers don't get the payment terms they deserve, or that would be optimal for trading. So that's a lot of money left on the table. I think commercial directors see it every day, but it's interesting to see that more than half of finance leaders actually acknowledge that pain. So I'll be very interested in seeing how you guys see that question. And then, yeah, what are the most significant pain points? I think it's very linked to what we said before, cash flow and predictability. Well, that translates into cash flow constraints, 63%. Managing payment terms translates into issues from collections and chasing debt, more than half. Non-payment from customers, it's that general theme. I'd love to hear from you if you see non-payment on the rise post-COVID, if you've seen a lot of cases around you. So this is it for a quick overview of the main insights. Now let's dive into the panel, and let's. Sorry, I went one slide too far. Let's dive in, and maybe Christian. Like a broad question, a bit generic, but given that you have your activity of consulting to a number of clients,
yeah.
I'd love to hear from you what you see now 2024 as the most common pain points that finance leaders experience around you.
Yeah, obviously that's a quite broad question, but I think you're touching upon a lot of the right things in the report here as well. So if I were to maybe reflect on what I hear from my B2B customers, then it's that those transactions in B2B are obviously slightly different, or at least often very different from other transactions. So they might involve larger sums of money. You might have a bit more tailored contracts, sometimes complex pricing models. Maybe you have some discount structures that are different from and other payment terms as well. Maybe even longer payment terms than you would have, right? And all of this just adds to that risk and making it more difficult to foresee your cash flow and handle your cash flow, right? So there is quite a few cash flow challenges associated with it, and obviously risk as well, right? So, and maybe another thing is that even though we see the tech revolution with AI and a lot of things going on, I unfortunately still see a lot of people having outdated ERP systems and other systems that might not tie very well in. They might not, work very well with other online platforms, maybe like yours in some cases because of the outdated tech. And those kind of things, the complexity of the transactions, the cash flow, the outdated tech kind of often leads to a difficulty in predicting demand forecast accurately, doing the traditional financial planning that finance functions are put in place to do becomes more tricky, right? Because you have a harder time foreseeing fluctuations and predicting the future, basically.
Volatility, yeah. And actually, maybe if I go on a segue, a slight one, what you mentioned just here with you've got all these AI great apps and so on that are appearing, but at the same time, when I look at our clients and around us, there's still a lot of good old Excel.
Yeah.
But,
there's a lot of legacy tech, right? And a lot of legacy models. So we've done it in Excel forever, and then suddenly we need to do something else. So there is a behavioral change element there as well, right? So.
Yeah, absolutely. So then, if I move to the next question around this tension between financial controls and business growth, maybe Jorge, being part of a fast-growing startup, how do you see that tension, and how do you ensure that your controls keep up with the expansion?
Yeah, that's a great question. So for that, I think implementing strong financial guidelines, and guidelines being a key word there, it's not a Bible, it's not something you need to strictly follow, but at least something that gives the different departments a clear understanding of where and what they can spend. So this is important while maintaining, obviously, some flexibility, because there will be always market opportunities out there. And in that case, the collaboration between teams, and again, the understanding of as a finance leader or as a finance department, what other teams needs and other team leaders request are. It's key. I cannot stress enough how important that part is. Also, I would say that during this expansion period, growth period, EBITDA, having a negative EBITDA is not uncommon, right? And it's sometimes even expected.
We've all been there.
Yeah, exactly. So we cannot
in the early days.
Exactly. We cannot be afraid of that. And for that, I think it's important to have a healthy balance between a payment structure between our customers, but also from our providers, right? And in that case, also all the things that Christian was mentioning about having more predictability or better underwriting process, which is also a challenge, right, Louis? Because also, as you mentioned, people want and need this underwriting to go quicker and quicker every time. So before we have 5 days to do the underwriting, but now that's too much and you end up losing the customer. So that's why it's important to also optimize towards tech solutions that can get a healthy financial for you.
Yeah, and this element of like making sure that finance doesn't become the kind of handbrake on happiness. How do you manage that kind of positive partnering? And maybe I'm gonna ask John, because John, having been through with various businesses in your career, how do you do that business partnering?
Yeah, I mean, it's a great question again. I mean, I think back to an earlier role I had, and it was working with a very successful entrepreneurial individual, and his message always was at the meetings was, don't let perfection get in the way of progress. So you apply that to business partnering, you apply that to controls. You got to think, well, where are we now, and how do we incrementally get it better without stifling the overall goals, the strategic aims of the business? It's easier to approach a situation from a business partnering perspective and say, okay, you're missing controls 1, 2, and 3, and 4. That's the priority, and we won't do anything else until they're in place. But what do you end up with? You ended up with other departments that aren't happy. You end up with staple sales, staple growth, whatever it may be, and that's just not the right approach. I've seen plenty of individuals try to do that and it not worked out. Taking a bigger picture view is going to be the key to success here, and remembering that finances is ultimately a support function for the rest of the business, rather than, in most cases, don't need to dominate all decisions.
And have you seen in that respect like a change from like you work for a range of fast-growing businesses and often innovative startups? Do you have like a particular drive from technology, or is it fundamentally always kind of, let's be sensible, understand proportionality, focus on controls 1 and 2, and 3 and 4 will follow a bit later?
I prefer the proportional approach. I think that the technology obviously makes the job easy, obviously is great, but at times that can lead to an understanding gap as well, though, because if you implement tools to make your job easier, that's great. You have to fundamentally understand what they're doing. You take even Zero as a great accounts platform. It helps you code, it helps you map your transactions, but if you don't know what it's doing, then you're just creating a problem for the future. And if as you said, I work with a number of innovative startups looking for investment, looking to go to the market. If you don't understand your numbers because the tech's done it all for you and you've just let it run, then you're going to end up a problem further down the line.
Yeah. So basically, kind of, there's no silver bullet, and it's about understanding the business and the priorities, and then having that proportional approach. Aman, is this something that you experience yourself, being pulled in all directions, but at the end of the day, no silver bullet?
Louis, yeah, I mean, I think that's exactly right. I think when you're in a business, you really need to understand the why of the strategic and what are we trying to achieve and how do we get to certain revenues or certain milestones, right? And within that context, I think everyone said the same thing. Partnering with your business partner, really understanding with how you can enable and support them is critical. The challenge is like identifying what the right level of controls are. And in my mind, I think it's about understanding the risks that you are willing to accept and educating everyone around the table that these are the risks. Let's take them in a measured way and we're okay to support growth. And then certain decisions where you really have to decide, actually, we can't cross that line because there's a regulatory reason or there's a compliance reason. But I think having constant communication and clarity around the why you're doing either controls or something else is very important.
So what I find difficult there is like, John and Aman is like, this is when we all agree on the priorities, but it often happens inside, at the exco or in the company that you have internal stakeholders that want certain things, then you have the regulator that wants something else, the client that wants those great payment terms and they want to pay using that currency or funky payment method. So eventually you're kind of pulled in all directions, and if it often culminates into the finance function. How do you manage those trade-offs? Maybe Christian, how do you see this? How do you deal with the tension eventually to say this is the direction we need to go?
I think it's difficult to give obviously one single answer there, but I think what Aman is referring to in terms of being, strategically minded and not just focusing on the numbers is really a key part here, right? So when I work with business partnering in finance with companies, I hear this constant struggle between controlling and enabling the business, right? And we end up feeling like in finance we become the bad guys who kind of puts a stick in the wheel and instead of being the ones enabling better decision making. And partially that's part of our job, but there is also a mindset change to it, I think. So, that idea of going from being reactive to being more proactive. I heard somebody saying that we need to be in front of the numbers, not behind the numbers all the time. So trying to get involved early on in the decision-making process with the business and being part of the decision-making rather than showing up after the decision has been made and some transaction is creating chaos in finance, and then you show up and tell them that they didn't do it properly. So maybe the best advice that I could give is, get involved early on and build those strong relationships with your business stakeholders, understand what it is that they're doing. And I think I'm basically just adding to what the two other guys said here, but, be part of the decision-making process instead of just arriving on the back of decisions and pointing fingers at your stakeholders, right? So.
And that timing element that you're alluding to, Christian, like, being on the front foot, being ahead of the curve, mm-hmm. This is becoming incredibly difficult with the rise of e-commerce when you have to make decisions like, do we take this client or not? Do we give them 60 days? Then, it has to be super quick. Yeah. How do you find e-commerce impacts this reality?
I think you're absolutely right. E-commerce, but business decisions in general are just the whole thing is speeding up and has been for a long time. So transactions are happening so much faster than they used to. So and in my humble opinion, at least that's my case, I don't have the brain capacity or the brain power to stay on top of all the calculations. So we need to leverage the technology here to our advantage and stay on top of that and use different solutions that are available to actually help us process the vast amount of data, and then instead focus on making better decisions and enabling better decision making. So it's easier said than done, but I think that's definitely what we need to do.
Yeah, and maybe Aman, I think we put you and the risk team under massive pressure here at Hokodo. because we're, to respond to our clients, we're committing to giving risk decisions within 300 milliseconds to have that kind of instant user journey online. What are the tools and or the patterns that you use day to day to have that speed of decisioning? What's your framework for looking at this world?
I mean, I think, Louis, one of the advantages, at least I find, is coming here very early and being able to almost build the finance tech stack from scratch, right? I think if you think about finance and accounting and strategic decision making, the fundamentals are your core data that you're using, right? And I think what we've been able to do fantastically well here is really leverage a modern tech stack. So we have real-time data that allows us to have a really solid foundation on what decisions do we need to make. And getting that data is actually instantaneous, where if you think about what I've seen in previous organizations, we've had the situation where just getting the data takes 3 days because there's an Excel model that needs to be updated and a bunch of other things need to happen. I think starting backwards with, we want to be a partner, we want to make decisions. How do we build our finance function alongside that? That is the first mindset that I think is the start of the framework. Right? And then from there, for us, it was always about thinking about that tech stack, understanding what the core function is, and then if it's accounts payable, what controls do you have in there? How does the tech stack enable that? And I think John mentioned this earlier. You can use Xero, but if you don't know what it does and what the risks are, you can really set yourself up for failure. So I think we've basically taken each function of finance, taken our tech stack, taken our data, so that it allows us to be in real time, so that we can make decisions there.
Yeah, and I think even with the best tech stack, like you always have that problem of the underlying data that has to be of good quality, because otherwise there's the old garbage in, garbage out issue. Maybe now let's move to one of the other big issues that was flagged in the report, and right now, that kind of lack of cash flow predictability that we're facing in the current environment. I'd be curious to hear, Jorge, how you manage this with the context of a growing startup, and at the same time the need to have some visibility on your financials.
Yeah, I think in that point, the name of the game will be balance. As I said before, it's important to have a balance between your accounts receivables and your accounts payables. And obviously, have a budget and a plan to align with. And well, in this case, is where technology best benefits you, right? So the more automation you can have, the more hours you can save from your internal team, the better. Because otherwise, as a finance leader, you cannot focus on both parts, right? You cannot be on the deep of the information and analyze it. There's just not enough hours in the day. So you need to have every technology you have in place. We were mentioning and joking about the Excel still being used. Obviously, Excel continues and will continue to be an important tool, but we need to optimize and ensure we have the best technologies in place towards this, right? Be able to, also as a finance leader, be the decision making, as John was saying, put ourselves in front of the numbers, not behind the numbers, be more proactive. Sorry, I think Christian was the one who said that. But it's important, that proactivity. And that's why the technology we need to put in place, it's important. Investing this is crucial for our company.
So I think you've all said it. There's an element of tooling that goes into there, but there's also there are humans behind the tools, and in general, there's a kind of, I'm seeing a general upskilling of finance professionals from just the accounting or a bit traditional bean counting side of the work, to people who have soft skills, can manage the trade-offs across the company and really have a broad view that reconciles the sales and the growth of the business, as well as the cost and the risk components. So how do you see those finance team upskilling and providing the kind of human oversight to run the modern tech stack, and how does the modern tech stack like liberate the individuals to then focus on the higher value adding tasks. And maybe Christian and then John, I'd love to have your view on how the finance functions that you drive, how does it evolve? What are the competencies or soft skills that you look for in your teams, and how has this changed over the past years?
I think that's a really good question, and that's a big trend in finance as well, right? The constant capability development, the learning development that needs to go into this transition as well, because you might get new tech, but you need to ensure that your finance team is also ready to actually do the tasks that remain, but also use and leverage the technology, right? So I think that there is a part of just acknowledging and accepting that roles are changing. When RPA was introduced some years back now, the roles changed because instead of just doing the manual task, people had to do exception handling and focusing on the critical cases instead, right?
Yeah.
And that's a little bit what we do today with AI and technology as well, right? That some of the even the more complex tasks will be automated, and then we're left with hopefully some more time to do some more value adding things, but also focusing on some of the more complex issues. So I think, and that requires obviously some upskilling of many roles, because the roles are changing, and the work that is left in finance is different from what it used to be, since tech is taking over a lot of it. And I do these huge finance academies around the globe with big organizations, and big part of that is equipping finance professionals to use new technology, but just as much honing their people skills and their interpersonal skills, all the skills that they need to use to work with the business, become more strategic in their work, and maybe focus more on driving the business forward rather than controlling the past, right? So I think there is a change in the skills needed, and a change in mindset also to be made.
Yeah, absolutely. John, is this something that you see as well?
Yeah, I would completely agree. I think we're moving away from the operating in a world where maybe the FC or the CFO was forward facing to the business, and the rest of your finance team are very much back office, tick box, that kind of mentality. In terms of soft skills that I look for, I mean, to be honest, the one thing you can't teach is initiative. You can't teach an inquisitive nature, and you can't teach that drive to learn, and that's what I look for in my teams through growth. You accept that the world of finance is continually evolving, both from a tech stack perspective and also a expectation of the wider business perspective, and having people that are willing to grow and learn and make mistakes on the way, and ultimately be the best version of that they possibly can be, and therefore the best version of the finance team they possibly can be, is what I love to see and I love to do.
Yeah, and it's I mean that sounds like so clear right now, because if I were a finance professional and I were 25 years old, I'd be like, wow, with AI coming and so on, I'm gonna have to reinvent myself several times during my career. There's no way I keep doing reconciliations, collections, and so on in the same old-fashioned way. So I think that the clock is ticking, and all those changes that we're talking about are probably going to pan out over the next 5 years, because it's all accelerating now. So it's amazing to see that there are so many kind of old-fashioned businesses that are still running those large finance departments with lots of people doing relatively petty tasks at the end of the day. So yeah, there's it's fascinating how this is going to I'd love to be able to fast forward in 5 years and see how the tech stack of the finance function evolves. Maybe a bit of a curveball there. when you guys look at the different tasks of finance, like from the accounting, the treasury side of things, then the accounts receivables, the accounts payables, where do you see the biggest changes? And you'd be thinking, you know what, these elements in the finance value chain, for sure, they're going to be pretty automated within 5 years. Anyone wants to take the punt?
I can say a couple of things on that if you want. I see a lot of changes happening, obviously in transaction processing. So what you guys are doing here in payments, obviously, is a significant thing that will change. But even in classical disciplines like planning and budgeting, we see automation arriving and making much easier. So some of the latest technologies can not just pinpoint deviations and figure out, you know, the underlying root causes, but also using, you know, large language models and stuff like the ChatGPT-like functionalities. They can provide written descriptions of why these variations are in the numbers, what might be causing them. So that traditional management report you do every month, where you kind of try to outline actuals versus budget. I'm not saying that is a task of the past yet, but actually we're seeing now that technology can even do complex tasks like isolating the root causes in between budgets and actuals and provide written commentary as well, right? So a lot of things are changing, even in some of the things that we thought would be core to finance forever almost. So
yeah, it's fascinating to see how fast this is moving. Then now moving a bit back to the one of the other considerations that's often key for finance, it's like, you know, a bit like the risk management side of it. And Jorge, maybe if you could talk about the financial risks that you see associated with your payments, your accounts receivables. How do you look at this part of your business?
Yeah, well, I would say that's kind of twofolded as well. The first one is to have the right mindset across the entire organization, because also the sales profile, they push too hard to sell to any company out there, and I try to get this mindset of sometimes if not selling, it's actually a good news, right? Because you could also touch some bullet of a big probability of default or not payment. And that is wrong for the business. So we need to, as a finance department, have this educated or educational task as well across.
Not every deal is a good deal.
Exactly. But that's what we need to say and constantly keep on the mindset of every team member in our organization. And well, the second one, and again, this goes hand in hand with the technology items we are speaking about, is have a clear and efficient underwriting process. Obviously, every business is different, and we need to understand that. We cannot say no to a startup just because they have a negative EBITDA, because I don't think that's the right approach either. But that's the type of automations you need to implement towards your underwriting process. It needs to be as strong as possible, because otherwise you end up losing money and negative cash flow, and that comes again to the first point of cash flow and productivity.
How often do you lose a deal because of, you know, you feel that you can't overstretch the company's balance sheet, or, you know, you need to preserve working capital? Is this something that you would often pinch you?
Yeah, I would say it's higher than I would like to, but still it's between 10 to 15% maybe that we need to reject the deal because of this process.
Yeah, I'm not surprised. Like in a previous life, I saw an organization that couldn't actually sell to Uber, like the big taxi hailing company. And I thought, like, back then, that this was actually a failure of the finance and risk department, to recognize that, yes, they were loss-making, but the backing of the company and the growth trajectory was such that, honestly, the risk of selling to Uber was not bigger than the risk of selling to Air France or Alitalia, which are companies that will go under potentially before Uber. But this is looking at those odd risks, and managing them is actually not always straightforward. Good. Well, I see that we've already consumed almost all of our slots. Let me check if we have any questions in the question section or in the chat. Actually, I don't think we do. So everything we said must have been pretty clear. That's good news. Guys, I'd like to really thank you for the insights. I invite everyone to actually download the report, Our Finance Leaders Ready for the Digital Transformation of the B2B Commerce. So more stats, more anecdotes on what we've been discussing today. So thanks everyone for attending. Thanks a lot, John, Jorge, Christian, Eman, for making it. And see you next time. Thanks, everyone.
Thank you very much.
Thank you very much.
Cheers.
Thank you.
Thank you.